Welcome back, Karen and Sam. We were just talking about how it's so hard for us regular Joes. We go to work every day. We're not keeping our eye on the ball, but that's why we need someone like you, because sometimes your stuff is spread out everywhere and you don't really even know what you have. What's kind of the answer to that?
You know, when we were just talking about the client that came to us and didn't understand their risk, when they initially came to that first consultation, it was just a conversation. How are you feeling about retirement? What are your goals for, what that looks like? And also, how much more time do we have until you're ready to retire? They still have about 10 years. And so we thought, okay, how do we position the next 10 years to make sure they are on track to hit their goals? And the first thing that we always want to do is figure out, what assets do you have? Let's put them all on your GPS. And as a reminder, that's our one-page snapshot: growth, protection, and saving. We want to make sure that those three things are covered. So we took all of their assets and we put them on the model so that they could see exactly where they were. Now, what was really interesting is that asking them to accumulate what are all of your assets and what does this look like was a little bit of a daunting task for them. And they took a little bit of motivation, right? We had to send a few emails, get a few calls, make sure we were all still on the same page. But it was just that it had been so long since they had really figured out what they had that it took some time. Once we got everything on the model, it turned out that they had between them 8 different 401ks.
Oh, wow. Because they'd left jobs.
At their previous companies. And they had left those 401ks at their old companies.
Now, I always say, no, let me tell you, if you leave your company, you want to take your money with you. Okay, honestly. And, you can roll that over. It's not taxable. It's considered an IRA rollover. Okay. But now you have that money where you can watch it, you can control it, you can have someone like us help you manage it or whatever you want to do with it. But unfortunately, 8 times, 4 for each of them, they left a company, left the money there, went to a new company, started a new 401, left that company, and so forth. So the daunting task was really, in some cases, because they asked for online statements and no, physical statements to be mailed, which many people are doing now. Yeah. It was hard for them, believe it or not, to get all of the information we needed. But once we got that information and once we were able to put that on the GPS, it became very clear exactly what they had. Above the line money, which is growth money, and below the line money, which is more conservative, income generating and so forth. And so the very first thing that we did was analyze, begin with the end in mind, where is it that we're trying to get to, right? And so they clearly articulated that within 10 years, they wanted to retire. And so because all of their qualified money, the IRAs, the 401ks, and so forth, $1.5 million was above the line. It was all in the market. Some was in some bonds, but of course, both have been hit risky this year, okay? We were able to make a recommendation to position 50% of that portfolio down below the line into a guaranteed income solution. Remember, we've talked about before, when you accumulate these assets in these retirement accounts, the end game is to buy a pension.
Right.
And so by doing that now, we were able to put half of that money below the line, so it took some of the risk off the table, allowing the other half to remain invested and get rewarded for the risk. So that was step 1 that we did.
Okay.
It's so interesting because once we meet with the clients, it's never okay, this is your overhaul, we're going to execute this tomorrow. Right. Each process needs to be explained and educated so that they can make an informed decision. Exactly. And then once they feel confident in that decision, then we take the first step. Once the first step is in place and we have a good foundation, then it gives us the opportunity to review the other aspects of their portfolio and their goals to make sure that we can approach them. But you have to approach each one individually. Obviously, our job is to make sure that the big picture is to be able to execute their dream retirement, but we can't execute everything at once. It has to be a step-by-step process so that they know exactly what they're doing. But remember, our big picture is to accomplish the power of 3. And the power of 3 means that we have liquidity, we have income covered, and we have the opportunity for growth. And so for this client, the reason that we started with guaranteed income was because we needed to make sure we were able to provide the income solution that they needed when they got to retirement.
Now, the first move that we did does not completely 100% the income that they're going to need, but it was a start. The assets that will remain invested will continue to grow for them, and in 10 years, we will position maybe some more in income, because neither of them have a pension with any of the companies that they've worked for or are currently working for. Now, the second step that we looked at was some tax-free income, because as we've also talked about on previous shows, we want to retire with 2 bags of money. We want that tax diversification. All of the retirement money, all of that income is coming out taxable.
Okay.
So to get some money on the tax-free side, the only 3 options are a Roth, tax-free municipal bonds, and cash value life insurance. Bonds are not a solution for them right now. Unfortunately, neither was a Roth, because they make too much money. So they couldn't make a Roth contribution.
Because of taxes?
Because of
the
income.
ramifications. Okay.
No, because of income. So if your income, if you're a single tax filer and your income is over, I think it's $144,000 right now, you phase out and you don't qualify to make a Roth contribution. Married couple filing jointly, it's closer to about $200,000, and they both combined make more than that.
Okay.
So they do not qualify to make a Roth contribution. So life insurance was the next place that we wanted to examine and contemplate. Now, she had a life insurance policy, but not enough. And he had a life insurance policy, which was the right amount, but not the right type. So that was our next step, was to help educate how do we then fill this gap.
Can you change? When you realize that that policy wasn't quite right, you can switch?
Absolutely.
So there's, when it comes to switching life insurance, no good advisor should be in the business of trying to replace policies, because the best time to buy life insurance is when you're as young and as healthy as possible. And you're never younger or healthier than you were yesterday because you're a day older today. So obviously the objective should always be to put life insurance in place as early as possible. But when you look at current existing policies that clients have, it's always worth it to just put a second set of eyes and make sure that it's completing the job that it was designed to do. And in his case, it was completing the death benefit job, but it wasn't completing the cash value, the income job.
It was a term policy. It was a long, expensive term policy, which again, if he died, which should never be the retirement objective, but if he did, she would have gotten the tax-free death benefit, no question. But we wanted to enter into it to say there are assets on the after-tax side which are underutilized right now. They had gotten an inheritance and just put that money in the bank. It was earning point nothing. They had also gotten a couple of other assets from her dad that just weren't maximizing the potential that they had. So what we did for her, she had a whole life policy, which was fantastic. We were not moving, changing, or doing anything to that other than congratulating her for making the decision of purchasing that at the time when she purchased it.
Good.
But just as in your investments, we want diversification, you should have diversification in your life insurance as well. So the second type of policy we recommended to get her to the number that she needed, because she didn't have enough, remember, was to use an indexed universal life policy, which I know you've heard of because we've talked about it before, where you get the upside potential of the stock market without any downside risk. So if the market goes down, zero is your hero. You don't get any interest that year, zero, but you didn't lose any money.
Right.
So we're looking at taking some of the assets that she has and using that as the premium payment, so it's not coming from out-of-pocket monthly income, but from assets, and exchanging it into something that will give her a bigger bang for the buck.
All right, we're going to take a very quick break. The number is 855-348-3073. Call now to make your appointment with the ladies of Compass Financial. We'll be right back.